So thank you. I want to do a pop quiz. Where do you think the best place it is to raise money? Is it A, friends, fools and family? Put your hands up. B, angel investors? Put your hands up. Come on, don't be shy. C, venture capitalists? Or is it D, the stock exchange? If you think it's a trick question, it was, because the answer is actually none of the above. The best place to raise money is by selling something useful to customers. Find a product or service that has affinity for the market, get it out there and ship it and sell it to customers and bring revenue in, right? Too many startups sit there going, oh, I'd love to start my business, but I just need to raise money from somewhere. I can't get going until I raise money from somewhere. That's absolute horseshit. Go out there, get your MVP out, get it to market, get revenue in, and then iterate based on customer feedback. A friendly venture capitalist is not the solution to all of your problems, right? You are the solution to all of your problems, right? You should get it out there and focus on things like ramen profitability. So ramen profitability is basically what's the amount of revenue you need to generate to pay for all your costs and also just survive on noodles, right? Because once you do that, once you can survive and cover your costs and get going, right, that increases the value of your company immensely because you're not desperate, right? Investors can smell desperation, right? If you come in there and you're burning money every single day and they can smell that smell of burning cash, they will wait until you run out of money to get a better deal, right? So go out there and try and get to ramen profitability as soon as possible. A few little startup tips here. So startup CEOs, there's a lot of things you're thinking about obviously in your day-to-day job, but to cut through all the crap, you have one job and one job only, right? Do not run out of cash, right? This is very important. Do not run out of cash. If you need to raise money, make sure you raise enough money to get yourself, at minimum, to a demonstrable increase in valuation of the company, right? The last thing you want to do is raise money, go along for a few months, and then die in the valley of death, right? And too many companies do this. They go, they raise a little bit of money, they get going, etc., then they run out of money, and they haven't really increased the value of the company in any reasonable way. They haven't got to maybe profitability, they haven't got to the first flagship customer, maybe they don't have a working prototype. So make sure if you go out there, you ideally want to raise money once and just get to profitability. But if you can't do that, make sure you've increased the value of the company, right? So you need to think about that in terms of how much money you raise. So important, do not run out of cash. Do not run out of cash. Companies rarely survive down rounds. If you do run out of cash, you will have a down round. Companies do not survive down rounds, and I'll show you in a second, a little bit later on this presentation, why you will not survive. It's really important to also remember that things take longer than expected. There's a very important rule that I think applies a lot to startups, and that's Hofstadter's law, which says a task always takes longer than you expect, even when you take into account Hofstadter's law. So, startup tip number 6, it's easier to ask for more money than less money, right? But be careful, you don't raise too much money, because if you raise too much money, you'll dilute yourself too much, right? And I'll talk about that in a second. It's also really important to think about investing from the investor's perspective, right? Is there a fund that is a natural investor in your type of company? You don't want to go to a biotech fund if you're a software company, for example, right? You want to make sure that the amount of money you're raising aligns with the size of their fund, right? So you really need to think about the metrics from an investor's perspective, because let me tell you, there's so many things that will actually determine whether they'll make an investment or not in your company. A lot of them have absolutely nothing to do with your company. They have to do with how much money they have to put to work, how many partners they have, how late they are into their fund, whether they're close to the end of life, need to wrap it up so they can only make investments they can get a quick realization on, and so on. The other thing to remember is that venture investing obeys the power law. And what this means is, if you're a venture capitalist and you invest across a portfolio of companies, the returns from those companies will not be normally skewed, right? You won't have a dotted line where some companies will make you 5x and some will make you 4x and some will make you 3x, etc. If you're really, 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 really lucky, you might bag a unicorn, right? And that might make you 10x, right? If you're extremely lucky, right? And the rest of the companies, pretty rapidly decay in terms of the returns. And most of the companies in your portfolio, you basically aim to, you won't even break even. You'll lose all your money on them, right? So to first approximation, a venture capital portfolio will only make money if your best company investment ends up returning the entire fund. And I'll give you an example about this. Ron Conway, who's one of the most famous angels in Silicon Valley Angels #1, invest in 400 companies, including Google, And it's not exactly clear, but he either lost money or just broke even, right? So, the whole spray and pray portfolio approach does not actually work in terms of a viable, investment strategy. And this is why, if you go to a $100 million fund and you say to them, look, I only want to raise $500,000, it's only a small amount of money, can't you just take a risk on me? This is why these venture capitalists will not be interested, right? Because if you think about it, right, if you hit the ball out of the park and you generate a 10 times return on that money, that's only $5 million. That $5 million return is on a $100 million fund. That's a 5% return. Now, the way venture capital funds work is you can't recycle money. Once you exit an investment, that's it. You've got to return those funds to limited partners, right? So it's actually, and given the fact that venture capital fund lifetime is somewhere over 7 years to 10 years, right? That's a really, really, really small return for a venture capitalist, right? And that's why they're not interested in making just a small investment. Well, you think it's low risk, but in actual fact, it's huge risk for them because they've got to spend all this time managing and talking to you and board oversight and all these other things that they do. So in actual fact, they need to deploy a fair bit of money. And if you've got a standard sort of $100 million venture capital fund, they will over time have to deploy somewhere around $10 million in your company. So if you hit it out of the park and generate 10 times return, you'll return the entire fund. Right? So the next tip is ask for more money, right? But be really, really, really careful that every dollar you raise, you're going to generate positive return on investment. You don't want to be in a situation where you're raising $1 and every dollar you raise, you make back 85 cents when you go there and you go to market plan. And Willis Halim later in the program will talk about this, and he'll go through a bunch of different startups that are out there and actually show you. It's quite illuminating when these companies eventually go public, what sort of return they're actually getting on their marketing dollar and how much money they really have to spend to get the growth they're getting. Another thing to think about from a venture capitalist perspective is they need to double down on their winners, right? So if you've got a portfolio of companies and one is a winner, you don't want to kind of spread the money around evenly across the entire portfolio. You want to double down on the ones that are going to make a big return. And this is what Benchmark did in Uber, and that's a really, really smart thing to do. You just want to put more and more money to work in your winners, right? The cardinal rule of venture investing is do not run out of dry powder. Right? And the reason why you don't want to run out of dry powder is because you want to invest in those winners, right? And the other thing is venture capital investing is last in, first out, which means the last person to stick money in, the Series B and then the Series C and then the Series D, etc., they're the guys that set all the rules, right? They can say, for example, to the previous investors, you need to pay to play, which means that if you want to keep your preference shares, you've got to put in pro rata the amount of money proportional to your shareholding to maintain your preference rights, otherwise you convert to common. So this is otherwise known as the golden rule, and the golden rule is he who has the gold rules. So the next tip for venture capitalists is cut your losers quickly, right? And that's why venture capitalists can be quite brutal, because most venture investments last longer than the average marriage. I mean, if you are a public company like mine and investors don't like your stock, they will just sell it. Right? If you're a private venture capitalist, there is no active market to sell this stock. There is no one they can go to. If they find someone, they're going to get a terrible deal. So bad venture capitalists will actively manage their losses, right? And that can be a very, very unpleasant experience for a long period of time. And trust me, I have been there. The next tip is, startup tip number 9, do not raise money from venture capitalists. If you do raise money from venture capitalists, make sure they have operating experience. Make sure they've built companies, make sure they've gone out there and they've done successes, because let me tell you, running a company is not smooth sailing. You have ups and downs, ups and downs, ups and downs, and only operators of businesses will understand to not get too excited when you have a success and not get too depressed if something goes wrong and the servers blow up or whatever it may be. The next tip is that most startup founders lose control of their businesses the second they take the money. And what I want to do now is I want to show you exactly how they lose control straight away. First of all, they do not get in a competitive position. So they go out there to raise money, and they talk to one venture capitalist, and they get excited about that venture capitalist, and they spend all this time talking to them, and they neglect everyone else and all the other options they have. If you're out there raising money, you need to shop till you drop, right? You need to go out there and get as many people interested in the same level of the pipeline as possible, so that when one person is interested and drops a term sheet, you've got someone else over here who's going to drop a term sheet as well. If you only get one term sheet on your deal, you will get screwed. If you have 2 term sheets, you can get a competitive position and maybe get a bit of bargaining going. If you have 3 or more, you can get a good deal, right? Most startups don't do this. They find the first person that looks like they're mildly interested, they dedicate all their time on that investor, and that's a big, big, big mistake. The other thing is that VCs use a thing known as information asymmetry to get the deal they want. VCs are very cunning, and there's a lot of years' experience here, decades of experience in investing. And if you focus on one thing like valuation, like I want this valuation, they can manipulate all the terms in those investment docs to get whatever deal they want. So in a liquidation event or an IPO or a trade sale, they can get whatever payoff they want. And it doesn't matter what they put in as undervaluation because they can manipulate all the other terms. When you sign a deal with venture capitalists, the investment documentation is a telephone directory thick. You need to read and you need to understand every single line of that documentation, right? Most startups do not do this, and so most startups get screwed. Important thing to remember, board composition. If you have a board of directors, there's a lot of things that boards do, but the primary role of the board is to hire and fire the CEO. Yes, they do a bunch of other things, but the important thing to remember is while the board's job is not to run the company, the board effectively has control because it can fire the CEO and that CEO can appoint a new management team at any point in time, right? So it's important to remember, if you lose board control, you potentially have lost control of your entire business, right? And this is an important thing to remember because there's a game over scenario. I saw a startup the other day. I loved it. I wanted to invest in it. I thought it was fantastic. They gave up after raising a few $100,000, 4 or 5 board seats. I thought this is an impossible scenario to resurrect from because the company needs a complete reset, even though the technology is great. Board should be odd numbers so you can make decisions. The best number for startups is 3. If not 3, the best number is 5. Keep it small. You do not need 17 people in a board of directors meeting if your startup is not making any money. Trust me, I've been there. My last company, I had about 17 people I had to assemble into a room for a company that was making no money. It was ridiculous. Normally, how boards are determined is you pass an orderly resolution. What that means is, in a meeting of shareholders, you do all the votes, and if 50% or more vote for a particular director, they are in. It's 1 share, 1 vote. So if you have a situation where you raise $2 million and a $6 million pre-money valuation, so 25% of the company is given up to the investors, under a normal, ordinary scenario, basically the founders would still control the entire board of directors. But what actually happens in the venture financing is they do something like this in their term sheet. And this comes from a term sheet that was given to me. The board of directors shall initially be comprised of 5 members, 2 will come from the VCs, 2 will come from the founders, and there'll be 1 independent chairman or 1 independent director. And they say and the way they structure this is the VC will have veto rights over that independent, and they must be unaffiliated with the company. Now the problem with this is from day one, 2 board seats have gone out, and then the 3rd board seat will go to this independent. There's a funny old joke in the public sector land, which is what's the difference between a shopping trolley and a non-executive director? You fill both with food and grog, but the shopping trolley at least has a mind of its own. You can refer to the golden rule. He who has the gold rules. Who has the gold? The VCs have the gold, so therefore you can understand what happens on day 1 with 3 versus 2. Game over. So allocation of returns on exit. So you've been focusing on the valuation all the way through your negotiation of the term sheet, but you haven't read the fine print. There's a thing called liquidation preference. This is quite evil. This is basically should be providing a downside protection for an investor in the case of a wind-up where there's no return in a trade sale that's greater than what they put their money in, or an IPO and so forth. This comes from a term sheet that was given to me. It basically said that if you sell the company to someone, this is not an IPO, you sell the company to someone, that the VC will get in the returns 2.5 times their money, and then they share pro rata in the proceeds. So let's think about that. You're raising $2 million and a $6 million pre, so you've given away 25% of the company. If your company gets acquired, right off the top, all the investors get $5 million. You get 0. Your company is to sell for more than $5 million for you to get a single cent. Right, and you can see in a $10 million exit or $40 million exit that you get a minority returns, and not until you get a very, very large number do you get something close to what your shareholding should be. But it actually gets worse than that. If you go out there and raise a Series B, the Series B investor will want at least that sort of deal, right? Because the golden rule, right? He has the gold rules. If they got that, I've got the money now, I should get that, right? So if they stick in $10 million on a $30 million pre-money, on an exit of $30 million or less at that point in time, you will get 0, right? So $12 million has gone in, you'll get 0 for $30 million or less in terms of an exit in a trade sale. You can see for $60 million, you can see for $100 million, right? So I've actually seen companies where they've had hundreds of millions of dollars of liquidation preference, right? So the company sells, and anything below $200 million, the founders get 0, right? Would you like to be a unicorn? Yes? Yes, everyone? No sweat. I will give you $100 million at $1 billion valuation, provided you give me a 2-time participating preferred liquidation preference. What that means is below $200 million, you get 0, and only above that, you get to share in some of the proceeds, right? So you can see here, potentially what's going on in Silicon Valley right now with these $1 billion valuations is, depending on what the terms are in terms of senior liquidation preferences, there could be a lot of downside protection for the investors that are out there. So that's also potentially a game over scenario. To help you in negotiating when you speak to investors, when they talk about things like liquidation preference and so on, there's a law firm in the US called Fenwick & West. Every quarter they publish a report of what is market across all the transactions that they see and their partners see. And this is a really good thing to have in your arsenal when you're negotiating with someone and they argue for a senior liquidation preference or they argue for participating preferred versus non-participating and so on. So that's an important thing to remember. Now remember I talked about down rounds and why companies don't survive. So there's a clause in term sheets called anti-dilution, and what that means is if you issue shares cheaper than what the VC paid for originally, they will end up converting at that lower price, right? There's a couple of different ways that the algorithms can work, but it's an important thing to remember, and this is why down rounds are brutal, because look, if you go to our scenario of raising $2 million on a $6 million pre, so you're giving up 25%, and then it doesn't work out, you haven't crossed that valley of death, and you have to do a down round, raising $1 million at a $3 million pre-money valuation for another 25%, the anti-dilution will cause that first VC not to dilute, and he'll stay at 25%. So half the company's basically gone out, right? And so this is really, really, really brutal. I don't really know of many companies that have survived that are all going through a down round when you've got liquidation preference. Or down round as is, right, to tell you the truth. That's also a game over scenario. So dilution, right? So VCs will tell you, don't worry about the percentage that you own of the company. Just worry about growing the pie. The pie gets bigger. Your valuation of your shares get bigger. That's great. Unfortunately, if you do raise too much money, right, you should raise just enough that you know you can generate a really good return on it, but not for a bit of leeway. But if you raise a lot of money, you can be a scenario like what happened to Box. Now, Box is a fantastic company. The product is fantastic. The founders are great guys. Yeah, I'm not saying anything bad about that particular company. I'm just making one particular comment about the funds they've raised. So Aaron Levy went out there and raised Series A, Series B, Series C, Series D, Series E, Series F, Series G, right? And the problem with that is everyone gets diluted when that happens, right? And I'll show you in a second what happened in that particular scenario. With Freelancer, I raised one lot of money before I went public, and that's it. And we managed to bootstrap the business. If you can do this, really focus on doing this, right? Because that means you get to keep a lot more of the company, right? When Box went public, unfortunately for Aaron, he should have had 5 to 10 times more equity. He only had 3.4% of the company when it went public. He should have 5 or 10 times more than that. All right. The other reality is that as you lose your percentage of the company, you do lose control in the form of voting thresholds, veto thresholds, control thresholds, and so on. So it's important to remember this when you read through all documentation, and there'll be a lot of things in your venture documentation around voting thresholds, and you have to pay particular attention to that. So that's also a game over scenario. There's another thing known as ratchets. You can have ratchets on revenue. So if you say, I'm going to hit this amazing revenue target next year, the VC might say to you, fine, but if you miss that revenue target, then what we'll do is we'll ratchet our shares up to a greater proportion. This also unfortunately happened for Box, where when they raised Series F, they raised $150 million at $20 a share from TPG, Texas Pacific Group. And it said in the documentation, this is all public, this is all, a great thing for you to do is to read the S1 filings of companies. Right? A lot of companies going public now in the tech space, you read through the documentation, you learn a huge amount of things about how they structure the businesses. In this, it said that the shares that TPG bought will convert at IPO at either $20 a share, or if IPO is less than that, at 90% of the price that the share eventually IPOs at. There was a second ratchet, which is a time ratchet, that said you've got to IPO before July of 2015. If not, we get $3 in value per share per year, paid quarterly, right? So this is pretty nasty. You had to get the company public very, very quickly, and had to do it so at a great price, which is hard to do. When you've got the time pressure, it's hard to get the price pressure, right? The unfortunate thing is that the IPO price was $14 a share, so the Series F converted at $12.60. So that immediately gave a premium to the investors, and you couldn't really, I mean, it's a tragedy here for Aaron, because when the shares actually opened on the market, it opened at over about $20. Right, so that was a real tragic situation, right? So you've got to be really careful about reading through this documentation, because that's also a game over scenario. And then you have things like management controls and vetoes. So this came from not just a term sheet, this came from a deal that I accepted with a previous company, right, that I was running, that I founded, right? And I see my former chairman kind of over the audience over there kind of rubbing his lips because he's going, I remember this. So in the deal documentation, I had to agree, because I was pretty much a first-time founder, right, and I was pretty desperate for the money, to all these vetoes. There were vetoes the investors had over the business plans, any deviation I had in operating for the business plan, share issuances, IPOs, winding up, asset sales, forming committees. Hiring and firing the CEO, employee option plans, acquisitions. That's not all. Spending over $100,000 individually on aggregate, borrowing of over $50,000, hiring a CFO, CTO, COO, VP sales, VP marketing, transferring shares, mortgages, leases, remuneration of anyone over $100,000, variation of any superannuation incentive share or bonus scheme, payments or transfers of assets, and any agreement signed. Can you imagine here, if you kind of get in the bad books, I mean, you basically can't run the business. It's impossible. And actual fact, I know of one well-known Australian startup whose investors, believe it or not, refused to approve any travel budget over $0 so she could not fundraise. How's that? I want to go raise the next round of funding while we won't approve any travel budget. We'll give you $0, right? Game over scenario. Venture capitalist wins fatality. Luckily, she paid for the travel out of her own pocket, found a great investor who came along and did a reset. The golden rule, he who had the gold rules, and you guys had the gold. But you can get yourself in pretty sticky scenarios, so you've got to be very careful there. So, in summary, do not raise money from venture capitalists. Sell something useful to customers as fast as possible. If you do raise money from venture capitalists, make sure they have operating experience, and please get yourself in a competitive position. And read and understand every single line of the documentation. That's most important. Thank you for your time.